Welcome to the Opening Bell Report.
Okay, picture this. It's early morning, you haven't even had your first cup of coffee, and you open up your trading app, and it is just a sea of red.
The kind of morning that just makes you want to close the app and, go straight back to bed.
Exactly. But you don't.
No.
You zoom in on the heavy hitter, the one everyone's watching, Nvidia, and you see it trading down at, roughly $182 in the pre-market, and immediately the noise starts.
It just creates this vacuum of anxiety, doesn't it?
It really does. All the bears come out of the woodwork. You check social media, you scan the headlines, and the narrative is incredibly consistent. They're all saying the party is finally over. They're claiming growth is slowing down. And, oh, my personal favorite, the AI bubble has officially popped.
It's a very emotional reaction. And, frankly, it's a very human one. When you see a stock that's had a run like Nvidia has, it's basically been defying gravity for 2 years.
Right.
And then it slips. The immediate instinct is to think, okay, the momentum's broken. It's just fear.
Yeah, it's that feeling of looking down and suddenly realizing you're standing on thin air. But today, we're going to try and push that fear aside. We've got a new analysis report in front of us that is, it's pretty aggressive in dismantling that whole bearish narrative.
Just the title alone is a bold claim.
It is.
Yeah.
57 billion reasons why bears are wrong about Nvidia.
It is a catchy title, sure. But what I appreciate about this specific analysis is that it promises to strip away all the sentiment. It wants to stop talking about how the market feels, which is, jittery, and start talking about the actual value.
The cash and the math.
The cash and the math.
So our mission for this deep dive is simple. We're going to look past the panic of that $182 price tag and look strictly at the fundamentals laid out in this Q3 earnings analysis. And apparently, the whole argument hinges on one single massive number.
That 57 billion.
57 billion. So let's unpack that right away. What exactly is this number, and why does this report claim it just completely disproves the panic?
So, to be precise, the number is $57.01 billion, and that is NVIDIA's revenue for a single quarter.
A single quarter.
Specifically Q3 of fiscal year 2026.
I just want to pause there and let that number sit for a second. $57 billion in 90 days.
It's hard to wrap your head around.
Let's put that in context. If you take Intel and AMD, two of the biggest legacy chip makers in history, and you combine their revenue, Nvidia is basically generating in 3 months what those guys fight to generate in a whole year.
That's a really fair comparison. If you break it down even further, it's something like $630 million a day.
A day.
Every single day. Weekends, too.
That sort of creates its own gravitational pull. At that scale, you aren't just a player in the economy, you are the economy.
Yeah.
But here's the thing that I'm trying to get. We know they're big. Everyone knows they're huge. Why does this specific revenue number matter so much right now?
Because of something called the law of large numbers.
Okay, refresh my memory. This is the idea that elephants can't sprint, right?
Precisely. In finance, there's this widely accepted rule that as a company gets massive, joins the trillion-dollar club, growth naturally has to slow down.
Right.
It just becomes mathematically very, very difficult to keep doubling your size. The baseline expectation for a company of Nvidia's size is that growth should naturally settle into maybe, 10-15%.
Because you simply run out of customers.
Yeah.
You saturate the market. So the bears are looking at Nvidia and they're expecting that elephant to finally start walking.
Exactly. They are hunting for the slowdown. But here is the reality check from the report. With this $57.01 billion revenue figure, Nvidia didn't grow at 10%. They didn't grow at 15%.
Okay.
They posted a 62% increase year over year.
62% at that scale.
It's unheard of. They aren't just defying the law of large numbers. They're treating it like a suggestion.
So if I'm hearing you right, the bear argument is growth is slowing. But the math, the actual numbers, say growth is accelerating at a rate that shouldn't even be possible for a company this big.
That is the core contradiction. And this connects directly to that bigger AI bubble narrative.
Because if the bubble were popping, people would stop buying the jet.
Exactly. If demand was just a flash in the pan, you would see this revenue number start to plateau. You'd see customers, Microsoft, Google, Meta, pulling back on their orders. But a 62% increase tells you that demand for AI infrastructure isn't just steady, it is aggressively expanding.
So the whole peak AI idea, the thought that we've already bought all the data center chips we're going to need is, it's just mathematically wrong based on this one number.
Based on the Q3 numbers, it's objectively false. The demand curve has not flattened, it's still pointing straight up.
Okay, so that's the top line. That's the money coming in the door. But I'm going to play the skeptic here for a second. Revenue is great, but the old saying, revenue is vanity, profit is sanity. You can sell $57 billion worth of gold, but if it costs you $58 billion to get it, you're going out of business.
And that is usually the trap with hardware, right? It's expensive to make physical things.
So let's talk margins. How much of that $57 billion are they actually keeping?
This is where the deep dive gets really fascinating because it highlights how NVIDIA is separating itself from essentially every other hardware company in history. We have to look at the net profit margin.
The bottom line.
The bottom line. And the report highlights that NVIDIA's net profit margin is sitting at roughly 56%.
56%.
56.
I feel like we need to double click on that because I don't think people realize how wild that is for a hardware company. Usually if I'm selling physical boxes, I have shipping, I have silicon costs, manufacturing waste. I'm lucky if I get to keep 10 or 15 cents on the dollar.
Oh, absolutely. I mean, look at the auto industry or standard servers or even laptops. Those are brutal businesses. They are fighting tooth and nail for net margins in that 10 to 15% range. If a hardware company hits 15%, they're throwing a party.
And NVIDIA is at 56.
Correct. And the report uses a great analogy here. For every $100 a customer spends on an H100 or a Blackwell chip, NVIDIA puts $56 straight into their bank account. Pure profit.
That doesn't sound like a hardware business. That sounds like a luxury brand. That's like Hermes selling handbags.
It's actually better than luxury. Even the high-end fashion brands, they usually cap out at 20, maybe 30% margins. To find 56% net margins, you usually have to look at pure software companies.
Right.
We're talking SaaS software as a service, companies that sell code, which, costs nothing to replicate.
So NVIDIA has effectively broken the physics of hardware economics.
Right.
They are selling a physical object, but with the profit profile of a software subscription.
That is the aha moment in the analysis. NVIDIA is operating with the economics of a high-flying software company, but they're doing it while selling tangible, physical goods, and that is just a complete anomaly in the business world.
And I'm guessing that comes down to their moat. They aren't just selling a chip, they're selling the whole ecosystem, the software, right?
Yeah.
You can't just easily switch to a competitor.
Exactly. That pricing power comes from that lock-in. It means they can charge a premium because there is no viable alternative that offers the same performance and, crucially, the software compatibility. So when bears say the business model is in trouble, they are ignoring the fact that this is one of the most profitable money-printing machines we have ever seen.
Okay, but this is where the bears dig their heels in. And I see this argument everywhere. I see it in comments on the news. They say, okay, fine, they make money, they have great margins, but the stock price has gone up too much.
Yeah.
It's just too expensive.
The valuation argument?
Yeah.
Right.
They point to the price to earnings ratio, the PE, and they say it's trading at 46x earnings. That's way too high. It has to crash.
And this is what the report refers to as the valuation trap. And frankly, calling NVIDIA too expensive at a 46x PE is, according to this analysis, maybe the single biggest misconception in the market right now.
That is a very strong statement. Because 46x does sound high if you compare it to, I don't know, a bank or a grocery store. So why does the report say that's basically a lie?
Well, first, you have to look at history. Context is everything. If you look at NVIDIA's 5-year average PE ratio, it actually sits around 66x.
Wait, hold on. So normally over the last 5 years, investors have been willing to pay 66 times earnings for this stock.
Correct. And today, right now, it is trading at 46x. So just from a historical comparison, the stock is statistically cheaper today than it has been on average for the last half decade.
That feels completely backwards, though. The stock price has, tripled or quadrupled in the last few years? How can the price be at an all-time high, but the valuation be cheaper?
It's all in the math of that ratio. You have P for price on top and E for earnings on the bottom. And yes, the stock price has gone up dramatically, but the E, the profit they're actually making, has grown significantly faster.
Ah, I see. So the denominator is exploding.
Exactly. The company's ability to generate cash has outpaced even the stock's incredible rise. So relative to the money they are actually putting in the bank, you are paying less for every dollar of NVIDIA's earnings today than you were 2 years ago.
That is a really crucial distinction. Price is what you pay, value is what you get. And you're telling me we're getting more earnings for our buck now than before the rally.
Yes. But the report doesn't just stop at historical comparisons. It does something I really love, a direct head-to-head comparison with their main competitor, AMD.
Oh, I love a good rivalry.
Yeah.
Because usually the argument is NVIDIA is the expensive luxury option and AMD is the cheap value play.
That's the perception. But let's look at the math. NVIDIA is trading at a PE of roughly 46x. AMD, the runner-up in this space, is trading at a PE of roughly 114x.
Wait, hold on. Did you say 114?
I did.
Yeah.
AMD is trading at more than double the valuation multiple of NVIDIA.
I need to wrap my head around that. So you have NVIDIA, the market leader, 80% market share, 62% growth, 56% margins, and they cost 46x. And then you have AMD, an underdog, lower margins, fighting for scraps, and they cost 114x.
That is the absurdity that the report highlights. The logic just falls apart. Why would any investor pay a massive premium buying the silver metal for double the price when they can buy the dominant gold metal market leader at a huge discount?
It makes the whole Nvidia's expensive argument sound almost ridiculous when you put it that way. It's like walking into a car dealership and seeing a Ferrari on sale for half the price of a Toyota.
And it goes back to what we said earlier about feelings versus math. People feel like Nvidia is expensive because the chart has gone up and to the right for so long. They have, acrophobia, a fear of heights. But the math says it's trading at a discount.
Okay, so we've dismantled the growth fears with revenue, the business model fears with the margins, and we've addressed the valuation. But there's one more layer to this, the safety net. The report mentions a fortress balance sheet.
Yes. And this is so crucial because even profitable companies can get into trouble if they just run out of cash. We have to talk about free cash flow. In the trailing 12 months, Nvidia generated $60.85 billion in free cash flow.
$60 billion, just sitting there. Available. Essentially, yes. And that is what we call fortress money. When you have that kind of liquidity, you are immune to a lot of the external problems that kill other companies.
Like interest rates. Because we know rates have been high, and that usually crushes tech companies.
Exactly. High interest rates are a nightmare for companies that need to borrow money to grow. If you have debt, high rates just eat your profits alive. Nvidia doesn't need to borrow a dime. They're completely self-funding.
So rates could go to 10%, and it wouldn't even matter to Nvidia.
They might even benefit because they'd earn interest on that $60 billion pile of cash. But beyond just safety, it gives them so much optionality. They can pour billions into R&D to stay ahead. They can acquire other companies. Or, and this is what shareholders love, they can do massive stock buybacks. They can just buy their own stock to support the price.
Right. It puts a floor under the stock. But there is one more catalyst the report brings up, and this one is really about the future. Everything we've talked about so far, that $57 billion in revenue, the margins, that is largely based on their current generation of chips. The Hopper architecture.
Right, the H100s.
Yep.
The chips that every CEO in Silicon Valley has been fighting over for the last year.
But we know what's coming next. The Blackwell platform.
The next generation.
The report argues that the current numbers reflect the past. The massive ramp up from Blackwell, which is their next big leap in performance and efficiency, it hasn't even fully hit the books yet. That revenue is really slated for 2026.
So the market is pricing the stock based on what they did yesterday with Hopper, but they're ignoring the tidal wave that's coming tomorrow with Blackwell.
That is the argument. The market is looking in the rearview mirror. The bears are shouting, "The growth is over," based on Hopper's amazing run, while the Blackwell cycle is just starting to right its engine. It suggests the earnings estimates for next year might actually be too low.
That's a wild thought. Okay, so let's bring this all back to where we started this deep dive. The stock is down. It's sitting at $182. People see that red number and they panic.
Right.
But the report has a specific term for this. It calls it a liquidity flush.
Yes!
Okay, liquidity flush sounds a little bit like a plumbing problem. Can we translate that into plain English? What does that actually mean for someone holding the stock?
Well, in a way, it is a plumbing problem. Think of it like this. Sometimes the market sells the stock, not because the company is bad or because the business is failing, but simply because traders just need the cash.
So it's technical, not fundamental.
Exactly. Maybe a big fund is over-leveraged somewhere else and needs to raise money, so they sell their winners. Or maybe an algorithm hit a trigger point that just automatically dumps the stock to lock in a profit.
So it's mechanical.
Yeah.
It's not that the store, Nvidia, isn't selling goods. It's just that the people who owned the stock had to cash out for their own reasons.
Precisely. It is a sale driven by the flow of money liquidity, not the fundamentals of the business. And the report argues that for the long-term investor, these flushes are actually opportunities. They're mispricings.
So it's the difference between a house price dropping because the foundation is cracked versus the house price dropping because the owner needs to sell fast to pay off a gambling debt.
That is a perfect analogy. The house is fine. The owner is just in a huge rush. And if you're the buyer, you want to be buying from the guy in a rush.
So if we look at the scorecard this report is providing, the contrast is pretty stark.
It is. I mean, let's sum it up. The bear case, the reason for the drop is basically, it's gone up too much and I'm scared. That's based on anxiety. It's based on feelings.
And the bull case.
The bull case is 62% growth, 56% net margins, a PE of 46x, which is way cheaper than the competition, a $60 billion cash flow engine, and, oh yeah, a monopoly on the most important technology of the century.
Wow.
That's based on math.
It really is a battle between psychology and a calculator, isn't it?
It always is in the market. In the short term, fear can drive prices anywhere. But usually, over the long term, the calculator wins.
So the implicit advice from the report, and again, we have to say this is from the analysis, not us giving financial advice, it seems pretty clear about what to do with that $182 price tag.
The action plan from the report is Ignore the noise. The math says this is a buying opportunity.
It's compelling stuff. It just reminds me that sometimes the scariest time to look at your portfolio when everything's red is actually the most important time to look at the data.
Absolutely. When emotions are high, financial intelligence tends to be low. The data grounds you. It stops you from making a huge mistake based on fear.
So here's a final thought for you to chew on, listener. We talked about how the market is pricing in the past with the Hapu chips. But if Nvidia is already generating 56% margins on the current tech, what happens to those economics if the Blackwell platform is even more efficient for them to produce?
That is the big question, isn't it?
Could we see margins expand even further? Or does the scale eventually break the model? Because if they can maintain 56% margins while doubling revenue again, well, we might need to invent a new word for profitable.
That is the trillion-dollar question. Can they defy gravity forever?
Only time and the math will tell. Thanks for diving deep with us today.
Always a pleasure.
We'll catch you on the next one. Stay curious.
Don't forget to like, share, and subscribe for more.